Okay, welcome back to Day Trade Like a Pro. It is February 26th, and I'm going to go over a couple of strategies of how to manage your entries and your exits, some ideas of how you could manage your stop loss, and hopefully something that will actually be helpful that you can apply right away into your trading. And so we'll get right into that. I want to make sure you can go to the website daytradelikeapro.com. You can find the risk disclosure on the bottom of every single page. Please make sure that you understand that trading futures is extremely risky, that you can lose all or more than all of your money, and that everything I'm going to teach you here today is for entertainment purposes only, and that you should consult a professional before making any financial decisions or making any investment decisions. So that being said, you can find the risk disclosures on the website. Let's jump right over to the chart. So what I have here today, and if you've been around for a while, you're like, that's not what his charts look like. I've been using the light gray background, and I've done that for a long time, or dim gray or whatever they call it. It's really hard to see some of the levels, and I'm trying to mess around with something. I don't use red and green candles because there's a bunch of science that shows, one, I think green makes you more creative, which is not really necessarily something that I want to be when I'm trading. I love creativity, just not sure I want to be more creative when I'm trading. And red makes you more emotional. So you see that big red candle makes you more emotional, and I don't want to be really either of those things when I'm trading. So blue and yellow are pretty neutral. Obviously, this is like a grayish black. So I know I'm going to get questions about that, so I'm just answering it now. And the dark background, old habits die hard with me, so it's going to take me some getting used to. I'm not saying this is the new look, but messing around with a few things. Anyway, that's not what you're here for. So let's get right to it. So if you know me, you know how I trade, and mostly I'm doing this. I'm going to make it available for everybody, but mostly I'm doing this for the people in the live trade room or the subscribers who are using prediction points. I want you to see how we are utilizing different levels and how we are, the way that I'm managing trades. So let's talk about first things first. The first question we have to answer is, where is the market going? And the second question is, from where is it going there? In other words, what is the market going to use? What levels is it going to use to move to those levels where we think it's going to trade to? So we have a target that gets generated. Where are we trading to? So coming in this morning, we had really a range between 51.11, that's up here a little bit, and then we had down to 5,082 half. And we can see that they held right here. It was really two ranges. It was '08, so it was 51.08, and then breaking above that would have been to 51.11, and then we would have needed more than that. We would have needed to break above 11 to continue higher. And then on the other side here, we had this level, which was 84 quarter. If I'm thinking of that right, let me tell you what the first part of the range was. Oh, 84, and then above, and then below that was 82. Was 82 half. Okay, so did I do that? Maybe I did my math wrong before. Nope, that was it. And that would go up there. Okay, anyway, so you get the idea. That was kind of the first part of the range that we had. So as we get to the top of the range, we want to be selling. So if you think about it like this, if we're taking a trade, there's really how aggressive is the entry, and the more aggressive the entry, the more aggressively we'll want to manage the trade. So, for example, if we know that the market, let's zoom in just a little bit and say we know that the market could pull back. Today's pretty sloppy, but let's say we know that the market could pull back to this purple line, but we try buying this green line right here or the green line right here. There's really not a whole lot to manage. In other words, this came down, hit here, and got back up out of this area. So if it came down here, we were looking to buy off of the purple line, and maybe we said we don't want to break. Well, we know that it could come all the way down here to 82. So this is 10 points away. at 92 down to 82, so we know that's 10 points away. So you have to be somewhat more aggressive in managing. If I'm selling up here at 08 and the next area up is only one more level up at 11, then what that tells me is that I am, I can be a little bit more conservative in the way I'm managing my trade. So I can be a little bit more conservative in the way I'm managing this trade. And so let's talk about what being more conservative looks like. Well, most of us think about a entry, and we think about it in terms of how, for example, this is a very aggressive entry off of the green line right here just before the open. So I'm going to want to be aggressive in the sense of how much room do I give it. So how many ticks or points am I giving it through the level? And we're just looking at a 5-minute S&P chart right now. So I want to be I want to be aware of how many points or how many ticks am I giving it through the level. And then I also want to be aware of how long is it staying at the level. So if we go look at this right here at the open, and let's just go back over here, what we can see is right over here at the open, what we see is that it hits right here before the open. And then this is a good example on the other side. I'm not saying that we're selling this, but let's just say we were selling the yellow line. What you see is that it comes up, it hits the yellow line, it probes it by a tick, so probes by 1 tick. So the price is fine. It hasn't gone too far through the price. What happens next is it starts to move away, never comes back to green, which is a good sign. If we entered off of green, it's not even coming back there, so that's great. And then moves back up. So look, if I shorted yellow, it gave me, I got short here on this minute, 1 minute, 2 minute, and by the 3rd minute, this is coming through here. Now, the more aggressive the trade is, and this would be super aggressive to sell right here, the more aggressive the trade is, the less time and the less room that I want to give it. So I need to give this less room than I would give, say, this up here. And what you can see is this came up and it hit 1 time and it hit 2 times. So a little bit more conservative entry on a short than versus down here. And what you can see is that it came back up. And this is really step number 1. You're having a set stop loss. It's 2 or 3 points or whatever you're using. It comes up. Okay, it hits 08 to the tick. So first things first, it hits to the tick. That's a really good sign. I like that. It doesn't break above it, not even by a single tick. So it hits to the tick. Now, yes, we have 07 3/4, and I left both of those on there because that's informing me of something. They're different prices. They're generated different ways. But I just want to show you. It hits it to the tick. And then it's 2 minutes, and it never came back. Now, let's say I think, well, maybe they're going to break out and they're going to go to 11. And I'm not saying that's how I should trade this, but let me just say, suppose for a minute. This would be literally, so how am I deciding how aggressive it is? Well, let's just look. They pulled back here. So if they didn't take out this low, they could stair step from any of these levels right here. So this purple, this green, or that yellow. They could stair step up through any of those levels. So this would be the absolute most aggressive entry I could take. So what does that mean? It means I don't want to give it a lot of time and I don't want to give it a lot of room. So if I get a reaction off of the level like I do right here, so see it opens right here, or it comes down and it hits right here at 03 3/4, and it goes all the way up to 05 1/4. And so it moves about 1.5 points off of the level and then comes right back to the level. Now I'm going to talk in a minute about how you can manage something like this, but let's just say, again, comes down here. This is still pretty aggressive because this could come all the way down to 82. So still very aggressive. It comes down, hits the level, comes up, holds purple, comes back down. I want to be out of that. Comes down here, probes down through here at 0.5, probes down, comes back up. This is going to be really tricky. Maybe you get stopped out. Maybe you're really, really good at managing it. Just kind of up to you. Then it comes down. We have the green line here at, I don't know, it's 97 3/4. It hits it to the tick, so it comes down, hits our level to the tick, and then starts to move back away. Now, here's a really good sign. This is an old level from yesterday or a previous day. It comes back and hits, or Friday or whatever it would be. It comes back and it hits that and holds it to the tick. So I really like that. So in this case, there's a few things I could do. It's kind of starting to get away here. I could move the stop just right underneath here at 97.5. I could move my stop there. I could move my stop back up to break even, but you know, so there's a few things I could do there. The difference is going to be 2 or 3 ticks depending on where I got in. It holds here. It comes back up. If we sold right here, notice how, again, let's say we sold right here at 0.375 and it came down. And let's say we're buying yellow because we want to get a move up higher. And I'm not saying that's a trade that we should be doing. I'm just saying if we took the long off of yellow, it's still pretty aggressive because we've been here, so it could still come back to green. So 1, 2, 3, 4, 5, 6. I mean, look at how long this is hanging out here. It's not getting out of this area. So 5 minutes is a pretty long time for it on a normal day for a trade that's pretty aggressive. Notice how this works. It comes down, it hits the level, it gets out of there. It doesn't even spend a minute there. So that's a great one. And it gets away from there, moves up. Now notice, comes down, hits yellow, moves away from there. Even here, notice it hits green, moves away. Hits green, moves away, comes back to it. So comes down, hits yellow, moves away, no follow through, comes back. You either get out of this up. You know, there's not a ton of room right here. It was a pretty small range day, but for sure you can move and get back to break even. If it moves 2 or 3 points in your favor, you can easily move to break even and get out at break even. It comes down here. This does not hold clean at all. It already tested right here. It does not hold clean. It probes it. It comes back up. Plenty of opportunity to get this trade off at break even. No reason to take a loss on it. If you don't buy here, which I wouldn't have, it comes up here. You could try it again off of this green. Again, it probes a bit lower here. You don't love that it's 3 ticks lower. Would rather it use it to the tick, but it's just kind of how it went. And then comes up here. It tries a few times. This is now what's happening. I want to get to the point of the day where it starts to make some more sense to be a little more. When this came down and broke 82.5, we knew that we had a move lower was very likely. So we had a few different levels, and I did a video about that went out to our members. And anyway, so the point of this being is that when it came up here, this area between 92 and we said 95, there's a 3-point range in here. And we said if they could hold 95, then we would see lower. So this is the most conservative place that I can enter a trade between 92 and 95. So what does that mean? It means I can be very conservative in the way that I'm managing the trade, meaning I can let it breathe a little bit because this is the most conservative place that I'm going to enter for this scenario to move lower. So I know, look how long this takes finally to get a move out of here. Now, you might have needed, maybe you tried it here and you took some profit here and then you resold it when it came up here and then it came down here and you took some profit here. And maybe you resold it here off 92 when it came back up here. It just, you know, how there was 92, 94, and 95. So I'm not going to get in the weeds of that. But you can get the idea of that you could be a little, if I sold it here and there's no follow through, take it off when it comes back, right? And this one did go 4 or 5 points. So not a terrible move. Plenty of time for sure to take it off. Almost 30 minutes or whatever. You could have gone back to break even. And then you can resell it again, maybe a little bit higher, maybe at 94. Maybe you try it at 92. But here's the point. If you tried at 92 and it probes through it just a little bit, you don't have to panic. You don't have to go, oh no, the world is ending and the sky is falling. You can just say, okay, I'm in this trade at the most conservative entry. I can let it breathe a little bit. I can give it a little bit of room. I can let it probe up to 94 or let it probe up to 94.5. It's going to be okay. I can do that. So you can give it a little bit of room to move like that. It comes down. See how it holds right here, moves down here. This takes forever, finally bounces back to here. Again, you see why I keep both these on here? It tests right there, and then it comes back and tests right there. So that's why I like both of those levels. And they're different levels. They have different purposes, and they came from different things that the market gave us. So, and then the move down through here. So That's how I want to manage my trades when I'm trading, you know, a big enough size that I need to be pretty aggressive about managing my stop. Now, let me talk about, I'm not suggesting that you do this. I'm saying there are traders that do it. There's a lot of fund managers that would manage things this way. I know some of them. I just want to give you an example. If you enter a trade and let's say we're primarily selling here. Okay, so we're looking for shorts, and the market bounces here, and let's say we sold 03 half and it probed up here and it probed 06. And if you're using like a 2-point stop, you're going to get stopped out. Well, one way you could do this is you just widen your stop out a little bit. So you bring your size down and you widen your stop out a little bit. And the reason I'm telling you this is because different traders they trade in different ways, and different things make sense for what they're doing. So you widen your stop out a bit. You don't have to panic on anything. It moves up here through to 06. Has anything changed? Do you now want to be a buyer? No, you really don't. So you can just keep that trade on, right? And then let's just say another example. So you don't have to be so, you lower your size. You take the same amount of risk in dollars, but you just have less size on. Okay, so that means you can widen your stop out a little bit. You might use a 10-point stop. I'm not advocating for that. I'm just saying it really is about knowing your own personality as a trader. How many times do you see things like this where it probes through a level? This would go get you stopped out, and then it comes right back, right? So let's just say here, let's just say right here, you go, okay, well, I think the bottom's in, and so now I want to be a buyer. So you buy it right here at 86 half, but if you buy with big size, it's the only trade you can do. You can't do anything else. But you could still very much make an argument for buying off of this level. So if you lowered your size, and maybe that means trade micros or whatever, instead of trading one mini here, maybe you trade 3 minis here. Or sorry, instead of trading one E-mini here, maybe you trade 3 micros, and maybe you trade 3 micros here. So you're just taking your normal size you'd be trading, you can spread it out across these levels. So maybe you bought here, and then you also bought here. And I'm not talking about like some kind of a strategy where you're like, you know, like a martingale strategy or something. That's not what I'm talking about. I'm just saying if you buy all your whole position and that's all you can buy here, okay, then you miss the opportunity to buy it at a better price. So I'm not advocating for this. I'm not saying I think you should do it. I'm just trying to give you some different ideas of how you could manage this. So if you get in here and it comes down here, and you can get in here again, you can take this trade back off at break even when it comes back there, or maybe you lose a tick or 2 or 3 on it, but this one you got a much better fill price on. And then you come up here and you get in at 92, and instead of panicking and getting out when it probes through here, you could say, well, I also want to sell 94.50. In this case, you would have never gotten that, so it doesn't ever give you that opportunity, but it ends up moving down lower here, and then it comes up. So you could take some profit, 2/3 or whatever. It comes back up, sell 94.50 right here, right there, right there, and then it moves down here, and it never came back to 94.50. So you could have moved your stop to break even and ridden this out, and then tried adding a little here. Maybe you added here. Maybe you held through this, or you got in a little bit better. Just kind of up to how you want to manage it. But I just want to give you the idea. Let's say this. It breaks through here at 89. Let's say 90. It breaks through here at 90. And instead of getting stopped out at 88, at the low of that move, or even down here, you have spread your risk out enough that you're not going to get stopped out. So what you can do is you can wait, and it comes back up here. I'm just saying, if you bought here and it comes down and comes back up here, now you can get back out. Now, this works if you're using the levels like what we're using, and you know that you can rely on what the market's giving you, and you know that it's a high likelihood that the trade will come back into here. So if you're in the live trade room, you know what we're doing, but I wanted you to understand how to manage and why we're managing some things very aggressively and why other things will widen, we'll maybe lower our size or open up our stop a little bit. And we decide all that ahead of time before we take the trade. So it's not like we don't get in the trade and then go, I think I'm going to give this more room. All that's determined ahead of time. It's like, okay, we know this is pretty aggressive. Maybe we want to, or just, you eat the loss and you move on and you do the next trade. But I hear so many times from traders, they go, the problem with trading levels is it'll just blow through a bunch of levels. And it's like, well, if you're just sitting there like a bump on a log and you're just watching what's happening and you're not being proactive about managing the position or managing the trade, that's one thing. And so the last thing that I'll say about this is that one of the tricky things that it really does take is you really do have to be proactive about managing the risk. And the other part of that is you have to be self-aware and know what's going on with you, because if you're in panic mode, you're going to do whatever you in panic mode would do. So there really is about having this emotional intelligence and emotional awareness and self-awareness to know what's going on with you and how is what you're doing affecting the decisions that you're making in your trading. It's a big thing I try to focus on in the trade room. So if you don't know, I am running a live trade room. I trade live Monday through Friday, the first hour and a half of every day generally, sometimes a little less, sometimes a little more, but usually that hour and a half, something like that. If you're interested in what we're doing in the live trade room, you get to see all the trades that I'm doing in real time. I walk you through it. I walk you through why I'm doing it, how I'm managing the trades, all that kind of stuff. And you are learning how we're mapping everything out the way that we have it mapped out here today and why we're selling where and buying where. Anyway, so if you're interested in that, you can just reply to the email that you got this, or just you can send an email, support@daytradelikeapro.com, and we'll get back to you. And what it would look like is you and I having just a one-on-one conversation, and I'll talk with you about what what it would look like to be in the room. There's no high pressure cells or something like that. It's really if it's a good fit, we can have a conversation about it. Otherwise, there's really nothing to do. So whether you're in the room, whether you ever join us in the room, whatever, whether we never do anything together, hopefully you've learned something and you can take what we're doing here in the way that we're managing our trades and you can apply that into your trading, and it will better you as a trader. And that's really what I hope for you. So if you want to learn more about what we're doing, shoot an email, support@daytradelikeapro, and I'm happy to talk with you about it at some point. Hope you're having a great day. Hope your week's off to a great start, and hope you continue to have a great week.